Hey Bill, I've come across some terms that I'm having trouble understanding. Debit notes, credit notes, and refunds. Could you help me out by explaining these concepts in simple terms?
Of course, Ethan. I'd be glad to help you understand these concepts. Let's start with debit notes and credit notes. Both of these are used to adjust the balance on an invoice, but they work in opposite directions.
Opposite directions? Not sure what you mean.
Let's say you have a customer who purchased a product from your company, and you have already sent them an invoice. A debit note is used when there is an additional charge that needs to be added to that particular invoice. It increases the total amount that the customer needs to pay.
Interesting. Why on earth would you want to increase the amount on the invoice after it has been sent to the customer?
Great question. For example, let's say a customer has a past due invoice that was not paid on time. In this case, you can issue a debit note to add a late payment fee to the invoice. The debit note would increase the total amount the customer needs to pay, accounting for the additional fee. This way, the customer can see the revised amount they need to pay, including the late payment fee.
That makes sense.
Another example of when you might use a debit note is if a customer's check bounces due to insufficient funds. In this case, the bank may charge a fee for the returned check. You can issue a debit note to add that fee to the customer's invoice, increasing the total amount the customer needs to pay. The debit note would reflect the bank fee, allowing the customer to see the revised amount they need to pay, including the returned check fee.
Got it. This helps Bill. I think I get it. So, a debit note is like an extra charge that gets added to the invoice.
That's right, Ethan.
Okay, but what about credit notes? You would use a credit note to reduce the balance on the invoice?
Exactly. A credit note, on the other hand, is used to reduce the amount the customer owes. Let's say the customer received a damaged product and you want to compensate them for it. In this case, you can issue a credit note to deduct a specific amount from the original invoice. For example, if the customer paid $100 for a product and the damaged item costs $20 to replace, you can issue a credit note for $20. This would adjust the balance on the invoice, showing that the customer only needs to pay $80 instead of the original $100.
Got it.
Another example of when you might use a credit note is for write-offs.
Write-offs? What is that, Bill? I have never heard of it.
Well, it is also called as bad debt write-offs. Businesses might want to write off an outstanding debt when they realize that the customer is unlikely to pay the full amount due to financial difficulties or other reasons. Writing off a portion of the outstanding debt allows the business to close the account and move on, rather than continuing to pursue a debt that may never be fully paid. It also allows the business to make an adjustment to their accounting records to reflect the fact that the debt is no longer outstanding. Let's say a customer owes you $100 for a product, but you realize that the customer will never pay the full amount due to financial difficulties. In this case, the finance team can issue a credit note to write off all or a portion of the outstanding debt, reducing the amount the customer owes. For instance, you can issue a credit note for $50, which would adjust the balance on the invoice to show that the customer only needs to pay $50 instead of the original $100.
I'm starting to get it now. Debit notes increase the amount owed, while credit notes decrease it. But how is a refund different from these?
Great question, Ethan. A refund is specifically used to return the customer's own money. Let's say the customer overpaid for their purchase or canceled an order before it was processed. In such situations, you would issue a refund to give the money back to the customer. So, while debit notes and credit notes adjust the balance on an invoice, refunds are separate transactions that involve returning the customer's money.
That makes sense. So, to summarize, debit notes and credit notes are used to adjust the balance on an invoice, with debit notes adding to the amount owed and credit notes subtracting from it. Refunds, on the other hand, are specifically for returning the customer's own money. This distinction helps differentiate credit memos from refunds, right?
Exactly, Ethan. You've got it. Credit memos and refunds may seem similar, but the key difference lies in where the money ultimately comes from. Credit memos represent amounts that the company owes to the customer due to adjustments, while refunds are the return of the customer's own funds.
Thank you so much, Bill. Your simple explanations and examples have helped me grasp these concepts much better. I appreciate your help.
You're welcome, Ethan. I'm glad I could assist you. Remember, understanding these concepts is crucial for accurate billing practices and for setting up the rules and treatments in Salesforce billing.
Roger that. Before we wrap up, I want to take a moment to address all the viewers out there. If you're finding this information about Salesforce billing valuable and if you're enjoying our discussions, I encourage you to subscribe to our channel and the weekly newsletter we send out. Check out the links in the description. By doing so, you'll stay up to date with our future episodes, where we'll explore each of these functionalities in detail. Also, if you know someone who could benefit from learning about Salesforce billing, please share this video with them. Let's spread the knowledge and help more people understand the power of this incredible tool. Thank you for watching, and we look forward to having you join us for our next deep dive into Salesforce billing.